Hello friends. In 2002, Stan O'Neill took over as a boss of Merrill Lynch and decided to shake things up. He saw a big chance in the world of mortgage securitization, which is basically turning home loans into something that investors can buy and sell. With interest rates being low, he knew investors were looking for ways to make more money, and this was it. O'Neill had a big plan: make Merrill Lynch a top player in this area. He gathered a team and they got to work, and the results were stunning. By 2005, they finished 31 big deals and did even better the next year with 34. This put Merrill Lynch right at the top of the game, making them a big name in mortgage securitization. But they didn't just stop there. They also got really involved in something called as CDOs, or collateralized debt obligations. These are a bit like a bundle of different loans. In just 3 years, they went from dealing with $3 billion in these CDOs to an incredible $44 billion. This brought in a lot of money for Merrill Lynch. Then, in 2006, O'Neill made a bold move. Merrill Lynch bought First Franklin, a company that gave out home loans. This was a game changer because it meant Merrill Lynch could now handle everything from giving out loans to turning them into products for investors all by themselves. It was like a one-stop shop for mortgage securitization. O'Neill's time leading Merrill Lynch really changed the company. They weren't just participating in mortgage securitization, they were running the show from start to finish, reshaping their world in the finance world. Back in the early 2000s, big financial companies, including Merrill Lynch, decided to take some bold steps. They started dealing with a lot of subprime mortgages, which are home loans given to people with less than great credit histories. This was a pretty risky move, but seemed like a good way to make money at the time. However, it was like building a house of cards, risky and unstable. Soon enough, everything collapsed. The subprime mortgage market fell apart really quickly, causing a huge mess in the financial world. Companies like Merrill Lynch, which had been doing really well with these mortgages, suddenly faced massive losses. This mess wasn't just a big problem, it changed the whole mortgage market and even the big world of investment banking. This fallout was huge. After this crash, the way banks and financial companies lent money changed completely. The days of taking big risks were over. Now, there was a lot more caution and strict rules. The people in charge of making sure banks behave, that's the regulators, really cracked down. They brought in a bunch of new rules to make sure nothing like this would ever happen again. Banks had to be more careful, check everything more thoroughly, and lend money more conservatively. This was a big moment that made the financial world rethink how it does things. It was like an alarm going off, telling banks and financial companies they needed to change their ways. Because of this crisis, the financial world is now more careful, follows stricter rules, and always remembers what went wrong to avoid the same mistakes again. When Apollo Global Management looked around the financial world, they realized things were changing fast. To keep up and grow, they decided to try something new and exciting. Instead of sticking to what they usually did, Apollo jumped into the world of creating and managing different types of financial assets. A big leap that showed they were ready to innovate and adapt. Apollo went all in with this idea. They didn't just try one or two things, but they started 16 different types of businesses that deal with all sorts of financial assets. Think about it like a buffet with all different kinds of dishes. They had everything from giving loans for buying houses and airplanes to helping fast food chains and car rental businesses with the finances. This mix of activities was like a colorful patchwork of financial deals. But Apollo wasn't just trying to do a lot of different things for the sake of it. They had a plan. This year, they aimed to create and deal with loans worth $45 billion across all these different businesses, and they're not just stopping there. Over the next 2 to 3 years, they want to ramp up to around $75 billion. It's a sign that they're not just dreaming big, but they also have the skills to make it happen. This big change for Apollo isn't just about making more money. It shows they're quick on their feet, ready to catch new trends and opportunities. They're not just going along with a change in the financial world, they're aiming to be at the very forefront, leading leading the way. Apollo's move in managing different types of financial assets is all about growing and trying new things and staying relevant in a world that's always changing. The world of finance has really changed because of something called securitization. This is where different types of loans like student loans or credit card debt are bundled together and sold to investors. It's not just about home loans anymore. This change has opened up new chances for making money, but it's also made things a lot more complicated and riskier for companies to do this. There are two big risks these companies face: liquidity and credit risk. Liquidity risk is when you're short on cash and can't pay your bills right away. For finance companies, this can be really a big deal. And then there is something called as credit risk, which is all about the possibility that people who took out loans might not be able to pay them back. These risks are tricky and they need some smart planning to handle them well. So what are these companies doing about it? They are stepping up their game and checking out who they lend money to. They're looking more closely at people's ability to pay back loans and keeping an eye on trends and changes in the economy. They're also spreading their bets by investing in different kinds of loans. So if one type of loan goes bad, they're not totally out of trouble. Another big thing they're doing is called as stress testing. It's like a fire drill for finance. They imagine worst case scenarios like a big economic crash to see how these businesses would handle it. This helps them figure out weak spots and make plans to deal with tough times. All in all, making and selling loans today is a bit like walking a tightrope. These companies need to be quick to adapt, but also careful not to take too many risks. Being good at managing these risks is super important for the long-term success, especially in a finance world that's always changing. In the world of finance today, there's a lot more attention from the people who make the rules, that's the regulators, on companies like Apollo. These are companies that do similar things to banks but aren't traditional banks. This extra attention from regulators started because of big problems in the financial world in the past, like the 2008 financial crisis. Now, regulators are really careful, watching over these companies closely to make sure nothing goes wrong again. A good example to think about is GE Capital. They were huge in the name of finance but ran into trouble because they didn't follow the rules closely enough. This hurt their business a lot and changed how they had to operate. It shows just how important it is for finance companies to play by the rules while trying to grow and do new things. For a company like Apollo, which is trying to grow and do lots of different things in finance, dealing with all these rules can be tough. As they get bigger and more important in the market, they'll get even more attention from regulators. It's like walking a tightrope. They have to keep growing and innovating, but at the same time, they need to make sure they're following all the rules. Finding the right balance between being innovative and sticking to the rules is super important. For Apollo and companies like it, being quick to adapt to new opportunities is great, but they also need to be really serious about following these rules. This balance is key in doing well in the ever-changing world of finance, where being creative and responsible go hand in hand. As we wrap up our deep dive into the dynamic world of finance, from Merrill Lynch's ambitious ventures to Apollo's innovative strategies, we'd love to hear from you. What's your perspective on these financial power plays and their impact on the market? Please share your thoughts in the comments section below. If you're captivated by ever-evolving narrative of the finance industry, make sure to hit the like button and subscribe to our channel for more interesting insights. Until then, stay safe and I'll see you all in the next video. Bye for now.